Hi, welcome back to Joe Blogs. This video is the next in a series looking at the financial implications of Russia's invasion of Ukraine on the global economy. And in this episode, I want to talk about shipping. Now, shipping's been a major issue that we've been looking at over the last 18 months. This all started back in the COVID period. When we had the COVID lockdowns, the world came to a grinding halt. And shipping and containers stopped doing what they were doing and just sat around waiting for the world to restart. And as the world did restart and we saw a massive increase in demand, we found out that there were major problems with the global supply chain because the ships were in the wrong places, the containers were in the wrong places, and we had factories opening and closing all over the globe, causing chaos. And as we came into the start of 2022, we still had a hangover from that period. We still had freight rates at very high levels, and we still had a container crisis. Containers were sitting in the wrong locations, and ships were taking much longer to come into dock, be unloaded, be reloaded, and then leave because of some of the restrictions from COVID. So we still had a very chaotic period. But since the start of Russia's invasion of Ukraine, things have got worse in terms of we've seen a massive increase in the cost of fuel. Oil prices have leapt by around 50% since the war started, and it's likely that they're going to stay at high levels for the rest of 2022 and probably into 2023. But it's not just oil prices and the legacy issues that we've got from COVID that are causing problems. We've now got issues with regards to the price of shipping. And in this video, I want to go through some of the details, some of the deals that have been done over the last few months on old rusty ships is incredible. And the problem that we have for the global economy is that these deals are being locked in on 3 and 4 year leases. So they're being agreed at extremely high rates. And those rates mean that shipping carriers will now have high fixed costs that are going to feed through into freight rates for a number of years to come. So in today's episode, we'll give you a quick recap on what's going on with regards to freight rates, where we are right now. We'll then look at the boom time for shipping, and I'll talk you through some incredible deals that have been done. With the benefit of hindsight, the two things that I would have invested into at the start of 2022 were oil and shipping. They are going to do really well for the rest of this year and probably into 2023. If you owned a number of ships, doesn't matter how old they were, whether they were ready for the knacker's yard, whether you were about to decommission them, you would be making a fortune from them right now. Ship owners are currently turning rust buckets into gold. There's never been a better time to own tankers. So I'll go through some of the details and I think you'll be quite amazed at what's being done. And then we'll talk about the implications for the global economy. And then finally today I'll wrap up with my summary as to what I think is likely to happen to the global economy as a result of what's going on with shipping. So before we get started on all of that, as usual, I'm going to ask you for a thumbs up at some point during this video if you're enjoying the content, and also to subscribe if you haven't done so already. Don't forget, I always include chapters in these videos, so if there's a section you're not that interested in, it's really easy to skip over it. And if you'd like to support the channel, please have a look below where you'll find links to YouTube's Super Thanks and membership scheme, as well as Buy Me a Coffee and Patreon. So let's have a look at what's happened to global freight rates over the last couple of years. This chart shows the global container freight rate index from January 2019 to May 2022. And you can see that up until the start of 2020, freight rates were relatively stable and were considerably less than $2,000. As the impact of the pandemic started to unfold around the world, we saw rates increase dramatically. And by late 2021, the rate had increased to above $10,000. So that represented more than a 5 times increase over an 18-month period. Now, over the last 6 months or so, we have seen the rate come down, but it's still sitting above $7,500. So when you compare that to where we were in the middle of 2020, it still represents an increase of more than 4 times the long-term average. And this represents a major problem for the globe. If you look at what makes up freight costs, you've got a number of different factors. Firstly, you've got the shipping costs of actually purchasing or leasing the ship and insuring it and putting all the staff on board. Secondly, you've got the container costs, either leasing or buying containers. Thirdly, you've got the costs of moving all of these containers, loading them on and off the ships. And lastly, you've got the fuel. Now, these vessels are extremely heavy. If you're loading up 20,000 containers, that's putting a lot of weight. These vessels are absolutely enormous and they use a lot of fuel. And of course, what's happened over the last few months since Russia invaded Ukraine, we have seen the price of oil increase by more than 50%. And that's feeding into every different part of society. And shipping is no exception. The costs of paying for fuel for shipping have gone up by more than 50%. And of course, that's going to feed through into the cost of freight transport. So over the last 18 months or so, we've seen freight prices be pushed up because of supply and demand. We saw everybody wanting to buy things as we came out of the lockdowns and the globe reopened. There was a huge spike in demand. And because containers and ships were in the wrong places, we had a disconnect between supply and demand because the demand had gone up exponentially and we just couldn't satisfy it in terms of moving all of the products. So that meant that prices went up, and they've stayed high because we haven't really fixed that global supply chain problem. But now we've got an added factor. We've got a massive increase in the price of fuel. And fuel is a big cost when you're a shipping company. If you're having to move very heavy vessels over long distances, thousands and thousands of miles, then you're going to use a lot of fuel. And of course, that's going to feed through into the prices. So we may be starting to get over the container crisis issue, but we're now encountering a new problem. We've now got issues with regards to increases in the cost of fuel to move those ships. One of the consequences of the rise in freight costs is a boom in the shipping industry. Companies that own and lease ships are now making extraordinarily high profits, and the deals that are being locked in by these companies are likely to lead to longer-term increases in freight costs and potentially will drive inflation globally for longer. It's been reported that some companies are transforming rust buckets into gold mines in a modern-day alchemy that could fuel already rampant inflation. The disruption to world trade caused by pandemic lockdowns and shortage of new cargo vessels has pushed freight rates for aging container ships to record highs. Cashing in on the boom, shipping companies are locking in long-term leases lasting 3 to 4 years, which means consumers could carry on paying the price for the surge in costs until hundreds of new ships on order come into service. The Synergy Oakland, a mid-sized vessel flagged in Cyprus, can carry more than 4,200 20-foot steel containers. Greek firm Euroseas bought the vessel in 2019 for $10 million, when it was already a decade old. As world trade spiraled into chaos during the pandemic, it raked in $21 million in just over 100 days, at the highest daily freight rate in history for a ship of its size. It squeezed in one more short-term charter after earning around $10 million in the space of 2 months, before going out on a 4-year lease at $61 million in May, a 6-fold return in itself on the purchase price from 3 years prior. The surge in demand for consumer goods during lockdowns, congestion at ports that tied up ships for longer than expected, and a slowdown in new shipbuilding, partly due to uncertainty about whether vessels would comply with new environmental rules, all contributed to the shipping crunch and record freight costs. Container capacity jumped 4.5% in 2021, mainly because aging ships that might normally be headed for the graveyard kept on sailing, but it hasn't been enough to cool prices. A recent review of 30 private transactions completed over the last 6 months show that ship owners are leasing vessels on long-term charters at record rates to capitalise on the once-in-a-generation bull market. In May 2022, the cost of locking in container shipments soared a staggering 30.1%, a record monthly increase in long-term ocean freight rates. The current, still high freight rates will continue to put pressure on consumer prices well into 2023, said Jan Hoffman, Head of Trade Logistics at the United Nations Conference on Trade and Development. I fear that freight rates will remain higher than pre-COVID for many more years. The Navios Spring, which is currently sailing from California to China, was chartered for 3 years in January 22 for $60,000 a day, a 7-fold increase over the $8,250 a day it cost 2 years ago. The ship, flagged in the Marshall Islands and built in 2007, cost its original owners $42 million, and it will earn $65.7 million over the length of its 3-year deal. The Navios Amarillo, a sister ship to Navios Spring, is booked on charters all the way out to January 2028, by which time it will be 21 years old. The ship will earn $75 million from that deal, far more than the $51 million it cost new. The container shipping industry as a whole made a mind-bending profit of $59.3 billion in the first quarter of 2022. which is up from 19.1 billion in the same period a year ago. The carriers are winners, and their significant increase in profits is being funded by higher prices for all products that move on container ships. Denmark's Maersk, the world's second biggest container line with a market share of around 17%, posted record earnings in the first 3 months of 2022. Revenues were up 55% to 19.3 billion, and it raised its forecast for underlying earnings for 2022 to 30 billion. A record 503 second-hand container ships were sold last year, equivalent to 7% of the global fleet, with another 108 sold in the first 5 months of 2022. With no container ships being scrapped this year, the average age of these vessels has risen to 13.9 years from 11 years back in 2017. This means that cargo ships that are 10 or 15 years old, an age which they were being scrapped before the pandemic, are worth up to 10 times what they were 2 years ago. In May 2022, MSC bought a Liberian-flagged cargo ship for $70 million, and this ship sold previously in 2007 for $7 million. New ships are coming in 2021. A record-breaking 555 container vessels worth $42.5 billion were ordered, and 200 vessels worth $18.4 billion have been booked so far in 2022. Some of these vessels will be among the largest container ships ever built, stretching over 1,000 feet in length, and will be similar in size to the Ever Given, a cargo ship that got stuck in the Suez Canal in 2021. So how big an impact is the cost of shipping on the global economy? Well, the IMF have undertaken some research on this exact matter. This chart shows the movement in shipping costs over the last couple of years and the knock-on impact on inflation of those costs. So the line chart on the left-hand side of this graphic shows the movement in the actual freight costs, and the bar chart on the right shows the inflation effects 12 months after the shipping costs increase. The IMF studied data from 143 countries over the last 30 years and found that shipping costs are an important driver of inflation all around the world. Their analysis shows that when freight costs double, inflation picks up by about 0.7%. But importantly, the effects are long-lasting and peak after a year and last up to 18 months. So this analysis implies that the increase in shipping costs observed in 2021 could increase global inflation by around 1.5 percentage points in 2022. So whilst the pass-through to inflation is less than that associated with fuel or food prices, which account for a larger share of customer purchases, shipping costs are much more volatile. And as a result of this, the contribution in the variation of inflation due to global shipping price changes is similar to the variation generated by shocks to global oil and food prices. Higher shipping costs hit prices of imported goods at the dock within 2 months and quickly pass through to producer prices, many of whom rely on imported inputs to manufacture their goods. The impact on the prices consumers pay at the cash register builds up more gradually, hitting its peak after 12 months. This is a much slower process than what's seen in the rise of global oil prices, which hit the pumps within a couple of months. Rising shipping costs affect inflation in some countries more than others. Countries that consume more imports see larger increases in inflation, and similarly countries that pay typically higher freight costs, which include landlocked countries, low-income countries and islands, see more inflation when freight costs rise. The IMF summary is that the inflationary impact of shipping costs will continue to build through to the end of 2022, and that the war in Ukraine is likely to cause further disruptions to supply chains, which could keep global shipping costs and their inflationary effects higher for longer. So how big an impact is the cost of shipping on the global economy? Well, the IMF have undertaken some research on this exact matter. This chart shows the movement in shipping costs over the last couple of years and the knock-on impact on inflation of those costs. So the line chart on the left-hand side of this graphic shows the movement in the actual freight costs, and the bar chart on the right shows the inflation effects 12 months after the shipping costs increase. The IMF studied data from 143 countries over the last 30 years and found that shipping costs are an important driver of inflation all around the world. Their analysis shows that when freight costs double, inflation picks up by about 0.7%. But importantly, the effects are long-lasting and peak after a year and last up to 18 months. So this analysis implies that the increase in shipping costs observed in 2021 could increase global inflation by around 1.5 percentage points in 2022. So whilst the pass-through to inflation is less than that associated with fuel or food prices, which account for a larger share of customer purchases, shipping costs are much more volatile. And as a result of this, the contribution in the variation of inflation due to global shipping price changes is similar to the variation generated by shocks to global oil and food prices. Higher shipping costs hit prices of imported goods at the dock within 2 months and quickly pass through to producer prices, many of whom rely on imported inputs to manufacture their goods. The impact on the prices consumers pay at the cash register builds up more gradually, hitting its peak after 12 months. This is a much slower process than what's seen in the rise of global oil prices, which hit the pumps within a couple of months. Rising shipping costs affect inflation in some countries more than others. Countries that consume more imports see larger increases in inflation, and similarly countries that pay typically higher freight costs, which include landlocked countries, low-income countries and islands, see more inflation when freight costs rise. The IMF summary is that the inflationary impact of shipping costs will continue to build through to the end of 2022, and that the war in Ukraine is likely to cause further disruptions to supply chains, which could keep global shipping costs and their inflationary effects higher for longer. So what's the summary and conclusion today? Well, as you've seen from the details that I've just given you, there have been some incredible deals that have been done for ship owners. They are making hay while the sun shines. There's never been a better time to put your ship out to lease. But the problem with those amazing deals is that somebody has to pay for them. And at the moment, it's the carriers, the people who want to actually move goods backwards and forwards. They're signing into these really high cost leases, and that means that their costs are now increasing. They've got a high fixed cost base. And of course, they're going to have to pass that on in terms of their rates. So these shipping companies will now be charging much higher rates to make sure that they get a profit over the next 3 to 4 years. So these are not short-term leases. These are relatively long-term in shipping terms. And of course, what that means is that we're going to see high freight rates all across the world for the next 3 or 4 years. There's still a shortage. The reason that these deals are being done, the reason that the shipping companies are earning such high rates is because there's a massive increase in demand. And as you'll know, if you follow the channel, whenever you get a situation where there's a big increase in demand and limited supply, price goes up. And in business, if your costs go up, that means that your prices go up to your customers. So we're all going to have to pay for this. It's going to increase freight costs. And as we discussed earlier in the video, the analysis that's been done by the IMF says that the increase in freight costs that we've seen over recent times has led to a 1.5% increase in global inflation. And now we're locking in the rates at those high levels. So it's likely that the impact on the global economy is going to be somewhere between 1 and 2% increase in inflation for the foreseeable future. Now that's a real problem for everybody because a lot of countries around the world have a target inflation rate of 2%. That's 2% in total, not for freight rates. And so if we've got freight rates that are causing 1 or 2% impact on inflation, then it's going to be impossible for any of those countries to get close to that 2% target. And this is at a time when we've got really high inflation across the board. Fuel prices are really high, food prices are really high, the price of everything is rising right now. And of course, the usual antidote to high inflation is to increase interest rates. And we've already seen the Fed introducing aggressive interest rate increases, and that's likely to continue. Until we see inflation coming back down, interest rates are going to keep rising. And that means that we're going to have an increased cost of borrowing for anybody that has variable debt. So anybody who's taking on new mortgages and new loans, any companies that have existing debt, they're all going to have to pay more for that debt. So that means that people will have less disposable income, they'll spend less, that means the economy will be shrinking and it's moving everybody towards that global recession much quicker. So whilst it's interesting and mildly amusing to look at the amazing deals that are being struck on old ships, overall, this is bad news for the global economy because we're now locking in these long-term agreements that will make sure that freight rates stay high, that will make sure that inflation stays high, that means that we'll see increases in interest rates, increases in borrowing, less disposable income, less spending in the economy, and probably a global recession. So I'll keep you posted on any further news and developments and any interesting stories like this that I come across. Hopefully you've found this episode interesting, informative and educational. If you've liked what I've said today, please give me that thumbs up and don't forget to subscribe if you haven't done so already.